Adjunct Professor Moran, Macroeconomics 111. We've been discussing exchange rates. We've calculated them and graphed them, and we've seen that exchange rates are inverses of each other between two countries. And we did some examples of what would cause the supply and demand for a currency to change. And the change in the supply and demand of a currency will alter its exchange rate. Here's a list of things that cause exchange rates to vary. Changes in tastes and for foreign products. So if you develop a preference for Japanese cars, then we're going to supply dollars to the international market and demand yen to get them, and that will cause the value of the yen to rise and the value of the dollar to fall. Income changes. If the United States enjoys prosperity, well, we'll buy more of our own domestic goods, but we'll also buy more imported goods. And so we will supply dollars to the international exchange market and demand their currency, which causes the value of the dollar to fall. For example, price level changes. If there's inflation in the United States, then we may substitute to buying foreign imports. So we would need to supply dollars to the international market and demand their currency. And again, in this scenario, the dollar would fall. Interest rates. International investors can invest in any country around the world, and they'll want the highest return possible. So they'll invest in countries which have high rates of return, either in the stock market or in interest-bearing securities. So if interest rates in the United States go up, other investors in other countries would supply their currency to the market, which would cause their currency to go down, and demand dollars, which would cause the value of the dollar to appreciate. There's also speculation on the value of a currency. Investors could buy dollars in the hope that the dollar appreciates and then sell them and make a profit for what they bought on them. So all of these five reasons cause international exchange rates to vary because of a change in the supply and demand of the currency. Occasionally you'll hear people say that we should back the dollar with gold and fix exchange rates at certain values. So for example, from 1879 to 1934, $1 was equal to 25 grams of gold. This is unwise because it requires a fixed amount of gold, and if you do this, a trade deficit and surplus will cause unintentional changes to the macroeconomic economy of the country. So for example, we'll take two scenarios and we'll assume that the dollar is fixed to a certain quantity of gold. Assume there's an imbalance of payments and we run a trade deficit. If we run a trade deficit, that means we've sent more dollars overseas than they've sent us their currency. So when we're done exchanging currencies, we won't have enough of their currency to send back. So we'll have to send them gold. So more dollars went overseas. When they send those dollars back and we run out of foreign exchange to send them back, we're going to have to send them gold. Okay. If we send them gold, if you remember from the chapter on monetary policy, the Federal Reserve supplies money. Now, if we have less gold, we have to contract the money supply. This is the demand for money. That will cause interest rates to rise. If this was our original aggregate demand, aggregate scenario situation, contracting the money supply will cause aggregate demand to fall. That's because consumers buy durable goods, often with borrowed money, and as the cost of money gets more expensive because of the interest rate rise, they'll buy less of it. Businesses also make purchases that are interest rate sensitive on capital goods, changes in inventory, and construction. And as when interest rates rise, those purchases by business will go down. It would cause a leftward shift in aggregate demand. If we had been at full employment, this will cause us to fall into a recession. An unintended consequence of tying the value to the dollar to an amount of gold and running a trade deficit. If, though, we run a trade surplus, this would be expansionary, which may not be the appropriate domestic policy at the time. Here, what's going to happen is we are going to send them back they'll exchange their foreign currency for our dollars, but we'll have foreign currency left over. They'll run out of dollars because we're running a surplus. We'll send them their foreign currency, and they'll have to send us back gold. Once they send us back gold, that's going to require the United States to increase the money supply, because we've tied the supply of money to the amount of gold the country has. So we go from supply of money 1 to supply of money 2. Given a demand for money, this would cause interest rates to fall. What impact would that have on domestic economic policy? Assume that we were starting at full employment. GDP real, price level. Expanding the money supply would cause aggregate demand to rise, because consumers would buy more durable goods and businesses would buy more gross private domestic investment, purchases of capital goods, all construction, changes in inventory. That would cause a higher rate of inflation, and it would cause unemployment to fall below the full employment rate, the natural rate, which would not be the appropriate monetary policy. The third scenario would be if the gold supply wasn't fixed. If the country discovered more gold, then they would have to increase the supply of money, which, given the demand for money, again would cause interest rates to fall. And if we were at full employment, we would again have an expansionary monetary policy, causing our demand to move into an inflationary area. So because of this lack of an ability to control monetary policy, if we tie the value of the dollar to gold, it is not a good policy. Today, exchange rates float based on supply and demand. So currencies appreciate and depreciate based on the supply and demand, which happens because of the reasons we discussed at the beginning of this video. Occasionally, though, a currency can fall so much that a country will try to support its currency, either by making it more valuable or less valuable. If a country's currency falls too low, it may try to prop it up by buying its own currency on the market or selling other currencies on the market, causing it to appreciate. Or it could cause its currency to depreciate if it becomes too valuable, cutting its imports. So, in 1987, the group of 7 industrial nations, it's called G7, it includes the United States, Germany, Japan, Britain, France, Italy, and Canada, agreed to stabilize the value of the dollar. During the previous 2 years, the dollar had depreciated rapidly because of large U.S. trade deficits. The G7 nations concluded that they would purchase large amounts of dollars, increasing the demand for dollars, which would cause it to appreciate. In 2000, the opposite happened, and the United States and the European Union sold dollars and bought euros to stabilize the value of the falling euro. So exchange rates for the most part today are flexible, with only occasional interventions by governments to support their currencies. And this concludes our discussion of international economics.